Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Happy Halloween, stock nerds! It's October 31st, and I have a treat for you. Not a trick, but a treat. So, folks, today there is no mailbag. There are no show notes. And I'm going to give a treat for the stock nerds, the hardcore groupies, the people that eat this stuff up every day, that always kind of complain that I talk about pie charts or us too much at the beginning of the show, where Wall Street takes your money and spreads it out amongst the small caps, the emerging markets, the bond. It spreads it out amongst all the big pie charts or the sectors, and then give it to their real clients because they're an investment bank. That's where that modern portfolio theory, that whole pie charts or us story came out, is to spread your money everywhere instead of the best of the best. But there is a better way, and we are going to show you today. And why is this important? I'm going to show you. I haven't framed these. I'm hanging these on the wall as we speak. I went to storage and got out all my old stock certificates. I got to have a little mini museum. But let me just show you here real quick, if we can. Here is the Dow in 1999. Dow, tops 10,000. Tops 10,000. Dow. 2009. In October, got back to 2000. So for 10 years, folks, it was dead money, a whole decade. A whole decade. What happens if you were going into retirement right then, lost half your money right before you retired? That's called sequence of returns. It's the new science. The portfolio management science is sequence of returns. It's not modern portfolio theory. It's a lie. Anyway, I digress. I'm not going to go down that rabbit hole yet again. I'm going to give you guys a treat today. We're going to turn it over to Don Vandenbord, Senior Portfolio Manager at Revere, a.k.a. Obi-Don Kenobi, the master. And he did IBD Live today, I think with Chris Gessel and Webby. Anyway, he did it, IBD Live, and they did a great show. And so I'm going to turn it over to Don right now, so our stock nerds can get their fix. So, Don, what did you guys talk about this morning, and what gold nuggets do you have for the listeners?
Yeah, I'm going to do the usual review of the indexes first, Dan, and then I'm going to go through the presentation that I did on IBD Live for all of our subscribers here.
That's right. Make them wait. Make them watch.
Well, they're tied together. You got to
bury the lead. No, I'm teasing.
Can't put the cart before the horse.
There you go.
So here's the S&P 500, and you looking at this, you would not know that last Wednesday there was a big liquidation event in growth land. And this is one of the reasons why we are 100% committed at Revere to maintaining a core position in the S&P 500 via, and by the way, SPLG, which is our preferred ETF, changed its ticker today to SPYM. Just FYI out there.
Was there a reason given for that, Don? Was there a reason?
They're rebranding or some nonsense like this. It doesn't make any sense. So the line that I have drawn here was last Wednesday, which was the 22nd of October, and we've seen this repeatedly time after time. We maintain that core position using 1-time SPY-M, 2-time SSO, 3 times UPRO or SPXL. And the reason that we do it is to catch these rotation days. On days when all growth stocks get hit, and this happens frequently, it shields your portfolio from big down moves, because in most cases that's not money leaving the market, it's just money rotating in the market from growth names to value names, and this has happened quite a bit over the last couple of weeks.
Right.
It's more obvious if you look at FFTY, which is one of our RG8 components. very clear
trackers.
here. Yeah, one of our 8, we use 8 ETFs in the RG8. It's 8 growth ETFs to make sure that we're very well aware what's going on in growth land. It may not be necessarily happening to our stocks or the indexes, but if growth stocks are getting crushed, that tells us to be wary. So you can see the top here, and then you can see the massive shakeout last Wednesday. Healthy, but painful. All it did is come back and touch the 50-day moving average. That's very natural as part of the O'Neill rules that leading stocks, and in this case, an index of leading stocks, pulls back to the 10-week or 50-day moving average before resuming its uptrend. And that's exactly what happened. Now, we used the 21-day moving average for a lot of our exits, and we got stopped on quite a few things. That's fine. So the question is, what happens after that? Because just like with how you need follow through to the upside, we watch for follow through to the downside, and we didn't get it. The next day we had a bounce, and FFTY regained the 21-day moving average, and we started buying some things back. And I'm going to the presentation is going to be tied to the technique that we used to properly position size and measure our risk for the things that we're buying back in case this rally to the upside failed. It didn't fail. We gapped up again on that Friday. We gapped up on Monday. We made a higher high on Wednesday. We had a pretty harsh pullback on Thursday, but all it did is pull back to the 8-day exponential moving average, and we're bouncing today. Growth name's up 1.24%. The S&P is up 0.5% as we record this at quarter to noon on Eastern time on Friday. So right now we're looking at an inside day on the FFTY. Let's go back to the S&P 500, and you can see after the shakeout, multiple gaps, a big reversal. You just go too far too fast sometimes, but a pullback, and all it did is touch the 8-day moving average before bouncing off there. A lot of these moves were related to the big tech names and their weight in the S&P 500 and the NASDAQ 100. It's going to impact it, those two indexes, because of how the market cap weighting works. If you look at the equal weight S&P 500, which we also monitor, this is the RSP. This is not acting well at all. Look at the massive relative weakness over the last week and a half. But we maintain a position in RSP for our smaller asset allocation portfolios, but we don't have a big position in this for in our typical portfolios. But this is just a signal to us that the average stock isn't working well, but that's fine. We don't buy average stocks. We buy leaders, not laggards. And the leaders are what are leading S&P 500 and the NASDAQ 100 back toward new highs, which they hit on Wednesday. Pulled back on Thursday, and now bouncing again. I say this all the time: as long as you're above the 8-day exponential moving average, which is what I have on this chart here, you can't complain about what's going on with the market. Let all the gyrations take place above there. If we break the 8, then we watch for the 21-day moving average. We break that, we start trimming positions. And our core position in the S&P will get reduced. We break the 50, same thing. You break the 200, you're at risk for a bear market. That's how we manage assets here at Revere. So there's the NASDAQ 100 back to the S&P 500. So what does this have to do with the individual positions that we buy? Because we've got half the portfolio allocated to the S&P at various weights, depending on how well the market's doing. In this case, it's doing very well. And then the other half of the portfolio goes to growth names. So after the big shakeout that we had on Wednesday, how do we get back in? We need to be participating if these stocks are bouncing constructively. So this is the presentation I did on IBD Live, and we're going to talk about it here also. People that follow us are very well aware of our growtection process, how we manage assets to grow them during uptrends, protect them during downtrends. We've talked quite a bit about the different techniques that we use to manage portfolios and risk: volatility adjusted beta, index reentry, balance at risk, parity in position sizing, riding the 8-day moving average higher, and what I'm going to talk about today, LREP shotgun. This is the technique for getting low risk entries after you have a market inflection point. You don't really know what the leaders are going to be, so we like to take the approach that we'd like to buy multiple small positions across a greater number of stocks instead of isolating on one or two names that may or may not be the leaders on the bounce back higher. So LREP shotgun stands for low risk entry point. Shotgun meaning we're taking a shotgun approach and buying multiple names. And why are we doing this? Same reason why we have solutions to the issues that frustrate investors. Cash drag, we've talked about this in the past. Improper entries, how to handle shakeouts, and this is really part of the shakeout is the re-entry after the inflection point happens. Not taking profits on the way up, and the fear bias after a negative inflection point. And this is what happened last Wednesday. If you get your clock cleaned, you're kind of hesitant to get back in, but we know that we can't argue with what the market's doing. If it's just a shakeout and the market shakes you out all the time, you've got to be able to get back on the horse and participate. In the theme of Halloween, don't be scared, be prepared. So in this case, first step you got to do is identify what stocks are holding up. And the second thing is how can I quantify low risk entry points to get back into the market? And we do it in a multi-step approach. So we identify the survivors. We're always doing that. That's part of our 2121 and Turbo 12 process, as well as the stocks that we discuss in our morning and afternoon meetings. So we've always got our watch list ready. Then we're going to do a data extract from Market Surge because we want to quantify this approach. We're going to apply formulas to identify what our risk is when we re-enter. We'll prioritize them based on their attractiveness. We'll set buy alerts, buy them if we need to. If we buy them, we'll raise our stops as they go higher. If not, they will get cut. And then we just repeat the process. Cut the laggards, pyramid into what's working, and then allocate to new buys as we rerun this process to find attractive entry points and increase our position size. So using this, we actually ended up taking 7 new buys or additions to existing positions on Grotection since after last Wednesday. Those were Palantir, SoFi, Hood, Tesla, MDB, and Snow. And we also added to Nail. That's the only one we've gotten stopped out on. The other 6 are we've got different varying size of profits in them. We'll be pyramiding into the winners at low risk entry points, and we'll be cutting the losers. So here's how the process takes place. It's a very simple extract from Market Surge if you use Market Surge. We just want the current price, obviously. We control the symbols that we want it for. And we want the 21-day ATR, the price against the 10-day, and the price against the 21-day. And then we're going to take that extract, use a formula to calculate the 10 simple and the 21 simple moving average. And then here is where the work takes place. We want to know the ATR of the name. We started with a standard position size of 2% so that we can see what the risk is across all of the names if we bought 2%. Got the current price there. We're going to use, in this case, the 10 simple moving average. The 10 simple and the 8-day exponential are very similar. Market Surge doesn't calculate the 8 EMA as an extract, but it does give the 10 simple. So we're going to use the 10 simple. And then our reference price is what is the 10 simple moving average. And then we're going to adjust it. We're going to use that as our stop to size against. And we're going to allow an overshoot by a half of an average true range on each of the individual names. So the less volatile stocks get a tighter stop. The more volatile stocks get a wider stop. So we're setting our stops, and then we're just going to calculate based on that 2% position size and where our stop would be, what is the risk to the overall portfolio? And that's this column right here. This is the key column. For protection, I'm looking for 10 basis points or less for a starter position. If it's less, I'm going to increase the position size to get it up to 10 basis points. So this means if I shotgun 6 stocks at the position size to where they're all going to risk 10 basis points, I'm only risking 0.6% of the overall portfolio to re-enter the market. So the key is to get those low risk entry points. And it's very much based on the rule that during strong markets, so we didn't know last Thursday or Friday if this was going to be a 1-day bounce, a 2-day bounce. We had the Fed this week. We had a bunch of earnings. We didn't know what the market was going to do. But we do know that if the market is going to be strong, these leading stocks ride the 8-day exponential and or the 10 simple. They ride them higher on the chart. You see it all the time. We talk about it in our videos all the time. So using that as a stop is a very logical, very tight stop. So then all we're doing is identifying which of these names are providing the low risk entry point that we're looking for. And when I ran this last week and early this week, this is as of yesterday, I think. So it's different now than where they were when I started doing the entry points. But based on that, we did those 6 buys. 2 of them we did 2 buys on. So it was actually 8 buys altogether, plus nail, which we got stopped out on. And we're showing a profit on various profits, but a profit on all of them. So this is the approach. This is how we did it. Let me go through those 6 names. And we'll talk about when we bought them and why we bought them. So Palantir was one of them. Palantir was bought on Tuesday. So back here, after it moved up higher off of this consolidation and offered a 10 basis point entry for a 1.5% size, versus the 8-day exponential and or 10 simple moving average. And you can see it's continued to move higher since then. So we're raising our stop. And if this keeps up, we'll be at break even. Then we can either pyramid that, or if it gets too extended to the upside, do some offensive selling. So the first one was Palantir. We also did SoFi. This is actually one that we're slightly underwater. I said we're positive on all of them, but not with this one. But it hasn't triggered the stop. It's pulling back on lighter volume, not really doing anything wrong. We obviously would have preferred that it stick above this 30 level, but our stop hasn't been hit on this yet. And again, this is the 8-day moving average. You can also use the 10 simple, but we allow for a little bit of an overshoot to keep from the market shaking us out. This needs to regain this 30 level in the 8-day moving average today or early next week, or it's going to be on the chopping block. Hood was one that we added to twice. Got back above the moving averages, had a hard shake yesterday, but is up 7% today, ran into this 150 level, which is a normal resistance area. Tesla was another one we did 2 buys on. That had a nice earnings shakeout, pull back to the 21-day moving average, regained its strength, had another rough shakeout yesterday, but is back above the 8-day moving average. Not enough to get shaken out of after the gains that we made. So we're still in that as well. MDB, Mongo, came up to the top of this base, then pulled back. You can see it following through to the upside, little undercut and reclaim on Wednesday of the 8-day exponential moving average. And finally, Snowflake. SNOW, one that we bought this, let's see, that was on Monday when it moved above this ascending base pivot sized for against the 10 simple /8 EMA. Made a higher high today, touched the 8 EMA yesterday. That actually would have been a good spot to pyramid, but with the 2 big tech earnings after Thursday's move, that could have impacted this name. We decided to hold off, but we're certainly looking to pyramid into this as it's working. And that is it. Those are the names. That's the technique. and it's about getting back in, staying in sync with the market, with the leading names. We have a template that we use for all the portfolios in-house that fill out very similar data to this, tracking how much we're risking. I'm the most conservative in Growtection. Turbotection takes a little bit wider stops, but that's what the portfolio is designed to do. It's for taking a little bit more risk with some thinner names that maybe Growtection can't buy, but all risk managed against various support levels. And as we say, things ride the 8 EMA/10 simple higher. And if they break it, then that's a signal to you to possibly get out or at least trim your position, because we do want to see it continuing to ride this purple line that I have on here, that shorter term moving average. And it's something that we share across the board on all the portfolios, all the guys that are managing their positions against that.
All right, Don, I've got one question for the listener who's not a client. If you're a client, you already know. But for the listener, does your advisor sound like Don, or are they asking you to go to lunch or for a tea time? Are they that technical, and are they in front of the computer the entire day the market's open? These guys don't go out to lunch for 3 hours and just do stuff, and they're in front of their computer for an hour or two. When the market's open, Revere is on top of it, paying attention. Anyway, that's the whole reason. So one other thing. So Don, I wanted to clarify when he was talking about the Nifty 50, that FFTY, and some of the other G8. Those are actually indicators. We don't own those in our portfolios. That's to figure out where the strongest growth sectors are, or if they're rotating out, we can catch it very quickly. All right.
Yep.
But the other thing is, did you know that breadth is actually not good? A lot of small caps are selling off. Small caps are starting to look weak. They could be actually a short setup. It's actually a couple very, very large mega caps that are up. And if you've got a couple large mega caps that are up 3 or 4 or 5% when they're a trillion, multi-trillion, more than $1 trillion company, you could have 5 or 6 stocks up and all the rest of the stocks in the market down, and the index be positive. That's why Don always says you don't buy rotten fruit for a balanced diet. You don't need to get rid of the lousy stuff. Only keep the best of the best, and then have sell disciplines on those. You'll manage your risk far better than pie charts or us with some random date rebalancing. Anywho, Don, who's up next?
We are going to follow the same theme and talk about, each of the guys is going to discuss 3 names that they bought for their portfolios after the Wednesday shakeout. And we're going to start with Connor.
Yep. Thanks, Don. So, yeah, continuing the theme, the first name that I wanted to talk about is Teradyne. We took position in Turbotection, so did Growtection as well. And you can see, so go to the weekly to start out. And one of the main characteristics of an earnings gap is neglect, something that's been moving sideways. Wall Street, they're unsure about it. And it just, no one really has it priced correctly. And Teradyne absolutely fit this criteria. And it gapped out of a huge, 10, 20-year trading range that it had been in on an earnings report. And well, the numbers weren't crazy. What a lot of people liked was the guide. So management guided for a massive sequential jump in Q4 sales, projecting 920 million to 1 billion in revenues, and EPS of 1.2 to 1.46. And this was far ahead of what Wall Street expectations had. And this gapped up 20% on 255% above average volume. Again, you want to see big double-digit gains with volume agreeing with that, and that absolutely had that. And then during the day, it undercut the lows of that gap day, but closed near the highs of the day, and it offered a pretty low risk spot. We got this at around $172 a share. And since then, it's putting in a day 3 higher high today. And, can't really ask for much more. And if you go back and study some of the best the best earnings gaps, they will typically never live below that gap day lows. And so as this continues higher or consolidates, we'll be actively looking to pyramid onto this and also sell into strength if it starts to get extended. But day three higher high today, really can't ask for much more. So that's Teradyne. And again, this is a name that, not that many people talk about. And they also have some angles in robotics. If you look at their DAC from earnings, they're making some moves there, and that's potentially a big theme in the market and AI. So that was Teradyne. Next one is URA. And this kind of ties into Don's shotgun approach, right? You don't know what's going to be the winner, and that's why ETFs can be a great way. So we bought this URA on 1028, and the reason for this was gapping up as CCJ Cameco had a catalyst. It was an $80 billion nuclear partnership with the U.S. government, Brookfield Asset Management, and Westinghouse. And why we decided to go with URA is because CCJ is the top holding in this ETF. And not only is CCJ the top holding, it has other names like Oklo, which is a super high beta name that's quite frankly hard to trade. So you get that exposure in the ETF. And then it has some other ones like LEU, SMR, all those names that, using the ETF, we get the basket of all those names in a potential big theme. And if you go to the monthly chart, Don, this is breaking out of a, 15-year monthly base, and this is on the heels of, the need for power, AI data centers, the same story that's been driving a lot of these stocks and specifically the energy names. And this is URA is a great way to play that as it has, a lot of the top names, especially CCJ, and it's trading quite nicely. Found support at the 10-week moving average the other week, reclaimed all the moving averages. Nice volume coming in and a great way to play the need for power. So that is URA. It's acting pretty well, and we'll be looking to add on to this in the coming days. And then the next one is Amazon. This is another earnings gap. Actually bought this today at around $247 a share, and this one's breaking out of a 1-year base. Mag 7 stocks, they have amazing liquidity, they're strong companies, and Amazon has essentially been doing nothing. It's been, quote unquote, the dog of the Mag 7 stocks for years now, and potentially viewing this earnings report as a change in character. Um, and and the market is liking the earnings report. They revenue jumped 20% year over year to 33 billion for their AWS. And then they also raised the annual spending forecast to 125 billion, which is just basically reflecting the ongoing investment in AI hardware infrastructure and robotics. And Amazon is positioned the best for robotics in the Mag 7 space. So this is gapping out of this base, relative strength lines coming back up. Provided a low risk entry on the pullback this morning. And as long as it stays above those base highs, we'll look to add on to it. If it comes back into the base and breaks the lows, we'll sell it for a loss. But for now, it's acting pretty well, and see if this story can develop further.
Good stuff, Connor. Various techniques using to get in there. Two gaps, and really like that URA ETF. Normally, we stay away from single ETFs because we don't know. We doubt that they're going to be able to outperform the S&P. But you can tell from one look at the relative strength line on URA in this most recent period here that it absolutely is capable of far outperforming the S&P 500. So good stuff there. All right, Ted, give us your three.
Thank you, Don. So the first one I talked more extensively on the last podcast, and it's Google. And this one is unique because I tried it on October 20th, and then the next day was the day Don talked about in indexes where it looked like it was just the S&P 500 pullback to the 21 EMA. And I was shaken out of this one below its own 21 EMA. However, 2 days later, I bought it back on October 24th on the flat base breakout above 256. And that gave decent feedback quickly, and then got a nice pop on earnings. And if you want to check out the more of the fundamentals and the story behind Google, definitely watch the last podcast. But pretty much, it's just the convergence of artificial intelligence, autonomous driving with their Waymo, some of the breakthroughs in quantum computing in-house at Google with their Willow chip, and then of course their cash flow generating search and ad business are some of the factors driving Google. Pretty much, they just have a cash machine, and with that, it's like Google is almost a research lab fueled by this quote unquote infinite cash generating machine. And that is why a company like Google attracts Nobel Prize winners, and they're just driving a lot of innovation in the world today. The next one is MongoDB. We own this in Growtection and TurboTection. Um, Pretty simple setup here. We saw highest volume ever on the last earnings report on 43% year-over-year growth and 24% sales growth. And from that, on that earnings gap, it got up above the 200-day moving average and pretty much all moving averages. Yeah, above all moving averages. And that followed through for a couple weeks. And this really ran into resistance at the 350 area. Base sideways for 7 to 8 weeks. And this is just a really clean base from highs to lows. I think it's less than 10%. So that's extremely, extremely tight. The relative strength line went sideways during the basing phase, which is completely normal. But now, as we're breaking out, the RS line is starting to creep higher, and I think we maybe just made a new high. I don't have the values for the exact peaks going back, but it looks like we're starting to make a new high there so far. And they're just a software name. They have a partnership, pretty big partnership with Amazon, which reported yesterday, and Connor just talked about it, part of their AWS and cloud infrastructure. And just a typical can slim name. Marcus Smith says 176% growth rate. You can see the annual earnings are rising sequentially, even though 2026, 2027 um, doesn't have too big numbers right now. But yeah, high gross margins, double-digit earnings and sales, so fits the bill there. And then finally, APLD is a smaller name and part of the WGMI ETF. And it was the theme that we've talked about multiple times on the podcast already. It's the crypto miner to data center transition theme. And really, these businesses had huge data centers ready to go with GPUs for Bitcoin mining, and they're just in the right place at the right time. So you see the shift from all these types of names: APLD, Irene, CIFR, HUT, BITF. I think there's BTDR as well. All their leadership on earnings calls and throughout the last few months have been orchestrating a transition into data center infrastructure, as the demand, at least right now, is currently off the charts. And it was really just a huge prior run. And for those that watch Don's podcast um, on IBD, Mike Webster was talking about high tide flag. I forgot which name, but this is also a high tide flag type name. It made a 200% plus move. It started accelerating on earnings and then pulled back to the 21 EMA, undercut, reclaimed the 21 EMA, built some higher lows, and tried to break out today. But recent character in the market and this name, it's just been, it likes to reverse a lot currently. And that could just be an overall market regime as well in more of these growthier names. More recently, breadth has been quite weak, and the mega caps has been dragging the markets higher. So, this is the third name. It still looks good, still forming a high tide flag. WGMI as a whole group is also forming a high tide flag, so we're watching this area very closely. That's it, Don,
Yep,
from me.
good stuff, Ted. The WGMI is in the 2121 list. All right, thanks, Ted. Let's wrap it up with 3 names from Todd.
All right, the first one I'm going to talk about is a stock that I had sold before last week's sell-off, but I entered back into it on strength subsequent to that, and that's LITE, Lumentum, which is a company that is in the optical networking area, and they're benefiting from 3 major themes. First of all, their legacy cable and telecom business has resurged after the cable companies and AT&T and Verizon halted build outs of their fiber networks. And now that's back on to support the AI movement. And then you have the data center build out, which their optical networking products help speed up the transmission of data in and out of the data centers. And then finally, their industrial lasers. Well, this one I had bought back originally on June 12th. And that was after it had an earnings, not necessarily a gap, but it helped propel it back above its 200-day moving average and helped set it up in a nice little base. And the stock really just kind of rode along and had a few tests along the way of its 21-day moving average. Well, fast forward to recent activity. I sold my final position in it on 10/8, October 8th. After it had gotten volatile, reversed off the highs, and broke the 21-day moving average for the second time. Although the first time it did an intraday move and held, this time I just felt it was a change of character, so I had gotten out of it. And then for the subsequent few weeks, it just got volatile, but ultimately held up. And after last week, I re-entered it and forced myself to buy it back on 10/24 as it basically broke out to new highs. So I just reinitiated my position back into it. This was pretty much 100% gain in this, so I have some profits to play with in this position. So I re-entered it, and that was on the extreme resurgence of strength in this name. The second name I want to talk about is Tesla. Don had mentioned that in his segment. I have not been back in this stock, but on earnings on 10/23, I bought the reversal in a technique that we call the oops pivot. And basically, after it had a shakeout below the 21-day moving average, I entered it as it broke through the previous day's hot lows. Okay, which happened to also coincide with the 21-day moving average. So this was a low risk entry where my stop would have been at the lows of the reversal earnings day on the 23rd. And so far, this position is holding up, and I'll use a break of the 21-day moving average of the ultimate stop. I did want to talk about Teradyne, but Connor already covered it. So for my third name, I want to talk about a name that I got stopped out of last week, Snowflake, that I wish I would have re-entered. And I stopped out of Snowflake on 10/22. I had bought it on 10/20, really on a stochastic cross, a 60-day stochastic cross. You know, it had built this nice little cup base after its earnings gap and just started getting pretty tight along, the ADMA and the cup. And I just entered it on that, on that tightness. And really, I had a 2-3% stop on it because if it was going to break the previous day's lows, I was just going to stop out on it and punt it. And that's what happened, on the 22nd. And I wish I would have re-entered that back on the 23rd. And I didn't. And this is a good lesson that just because you get stopped out of something on a tight stop, if it resurges itself on strength, you had a low risk entry point on it on the 23rd. And that's just my final one that I really wish I would have re-entered on strength. Thanks, Don.
All right, Todd, good stuff. And Dan, that is it from the tech side. I will note that we are at lows of the day on the indexes. The S&P 500 is reversed. Most of the gap up. Let's go to a 5-minute chart here. There's the gap up. We pulled back a little bit, made another attempt at higher highs, couldn't make it. And now we're fading. So yesterday's lows are a pretty critical area that we'll be paying attention to. This is one of the reasons why every morning I write down the opening 30-minute range. It tells you who's in charge, the bulls or the bears. In this case, the 30-minute range was 68.50 to 68.79. We so it was basically around 68.79 was the high, 68.50 was the low. We broke above it, got back inside it, but now we're back below that level again. So below that range, bears are in charge. Inside that range, it's neutral. Above the range, bulls are in charge. And this is a secondary indicator that we use to basically tell us who's winning the day. And today, growth stocks seem to be acting very well. Looking at my screen, a couple of them are down, but the index is not holding up. Dan, with that, you can take us on home.
All right, folks. Well, did you like what you heard? And would you rather have Obi-Wan Kenobi with the force of Grotection manage your portfolio, or some advisor that wants to take you to lunch? Just look, I got plenty of friends. I don't need to go to lunch. I need to make me some money. That's on a risk-adjusted basis. Anywho, listen, if you like what you heard, just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. Just put your name and email address in there, and you'll get all of we do a daily market insight video, short 10, 15-minute video every night the market's open, tell you what the market strengths is, all the different indexes, and actually what we're doing in the portfolios for our clients. We're the most transparent advisor in the world that I'm aware of. But also, if you go to YouTube and you just type in Revere Asset and hit subscribe, you'll get this show. Zach will have this show out by about 1 before the market closes. On our newsletter, it goes out Saturday morning. So sometimes it comes quicker on the YouTube, so you want both channels. On our website, next to the subscribe, there's a Contact Us button. You can sit in there and send in your information and ask for a complimentary portfolio review or a topic or a stock you want on the show. Folks, happy Halloween from Revere Assets. Stay safe, be careful, and drive slow. There are kids out walking around. We'll talk to you next week on your money, not Wall Street's money, your money.
Because it's not how much you make in the markets, it's about how much you can keep.